Step 1. The scam. Your 401k probably went up last year. You probably also felt like you were falling behind. Both things are true, and they're connected in a way almost nobody talks about. Here's the contradiction. The stock market just had its best 3-year run in a generation. And yet, most people's actual lives, rent, groceries, childcare, a car that doesn't break down, got harder, not easier. The market is booming. You're not. Your grocery bill climbed. Your rent climbed. Your raise didn't keep up. And somehow the people at the top of those 10 companies became richer than some nations. If that feels disconnected, it's because the connection is hidden. The boom in the index isn't your boom. It's a boom for the owners of the 10 companies, and you own a rounding error of them through your fund. The gains flow up, the costs flow down. That's the entire machine in one sentence. Why? Because you don't own the market. You own a sliver of it. And that sliver has been quietly reshaped so that it's no longer a bet on the broad economy. It's a bet on one single thing. Over the past 3 years, roughly 80% of the entire gain in the US stock market came from artificial intelligence. Not from factories hiring. Not from wages rising. Not from small businesses expanding. From AI. And the 10 largest companies in the S&P 500, nearly all of them riding that AI wave, now make up more than 40% of the entire index. In 2000, at the peak of the dot-com bubble, tech was about 6% of the index. Today, AI-related stocks are over 30% by some measures. So when your index fund goes up, it's not because America got more productive. It's because 10 companies got more valuable. And when those 10 stumble, your retirement goes with them. The cruel part is that you didn't choose this basket. Someone else built it, sold it to your fund manager as diversified, and now your retirement rides on whether those 10 can outrun their own debt. You're not an investor in AI. You're collateral for it. And collateral doesn't get a vote when the loan comes due. This isn't a normal sector doing well. This is concentration, and concentration is fragility. When all the eggs are in one basket, a crack in that basket shatters the whole tray. And right now, your eggs, your pension's eggs, and your insurance company's eggs are all in the AI basket. Concentration like this has a history, and it never ends quietly. When a few firms dominate, they stop competing and start coordinating. Prices rise, wages stall, and risk piles up where nobody's looking. The 2008 crisis wasn't caused by one bad bank. It was caused by every bank holding the same bet. Today, every major institution is holding the AI bet, and the bet is bigger. Step 2. The mechanism. So who's actually behind this? And what's keeping it propped up? Follow the money, and you find debt. Historic, record-breaking debt. Start with the cost side. To build frontier AI, you need data centers, chip clusters, and power. Enormous amounts of all three. In 2025 alone, AI-related corporate debt issuance exceeded $200 billion. Oracle issued $18 billion in bonds in a single month. Meta issued $30 billion, the largest corporate bond deal since 2023. Goldman Sachs called 2025 a banner year for AI bonds, with more coming in 2026. None of that borrowing is free. Every dollar has to be repaid, with interest from revenue that hasn't arrived yet. This debt isn't backed by healthy cash flows. Oracle is now spending 57% of its revenue on AI infrastructure. Microsoft is at 45%. Across the biggest players, AI infrastructure is eating close to 94% of the cash their core businesses throw off. There is no cushion left. If a single project misses, there's nothing to absorb the hit. Imagine a household where 94% of every paycheck goes to one loan. That's the position these companies are in, except their paycheck is the cloud business you and every other company already pay for. And the financing is circular in a way that should worry you. NVIDIA agreed to invest up to $100 billion in OpenAI, but much of that money flows right back to NVIDIA as OpenAI buys chips. The investment firm GMO compared this to the circular financing of the dot-com era, the exact thing that made so many companies fragile back then. Michael Burry warned that depreciation schedules for data center chips, booked at 5 to 6 years instead of a realistic 2 to 3, could be hiding more than $175 billion in losses already sustained. In plain terms, they're pretending the hardware lasts twice as long as it does, so the books look better than reality. Now look at the revenue side, because that's where the whole structure leans. Sequoia Capital estimated the AI industry needs to generate about $600 billion in new annual revenue just to justify what's already been spent. By 2025, that gap widened to roughly $800 billion. Annual AI infrastructure spending is about $650 billion. Actual revenue is about $50 billion. That's a $600 billion hole every single year. To make that concrete, imagine a restaurant that spent $650,000 on a kitchen and serves $50,000 of food. Then it borrows another $200,000 to build a bigger kitchen, confident the customers will show up. That's the AI industry, except the restaurant is the backbone of your pension. The bet is that demand will explode before the loans come due. So far it hasn't. The 3 biggest cloud providers spent over $150 billion in capex in 2024, yet AI-related revenue is less than 5% of their total. And MIT studied how generative AI actually performs inside companies and found that 95% of corporate AI projects produce no measurable impact on profits. Not small returns, zero. For a young industry with the most expensive infrastructure build-out in human history, that's not a speed bump. That's existential. Consider what that means in plain terms. A bank deploys an AI chatbot that answers customer questions. It costs millions to build and run. The MIT study says it didn't move the profit needle. But the bank still has to pay for the chips, the data center, and the power. And that cost lands in the same place your fees and your interest rate come from. The AI didn't make the bank more efficient. It made the bank more expensive to run, and you're the one covering the difference. Now the macro tightens around all of it. The Fed is signaling possible rate hikes, not cuts, because inflation won't die. Japan's central bank just raised rates to a 31-year high, pulling global liquidity back, the exact liquidity that high-risk bets like AI depend on. Higher rates make every dollar of that infrastructure debt more expensive to carry, and they punish the profit-later models of OpenAI and Anthropic most harshly. The money that was free is now expensive, and the bills are due. The timing couldn't be worse for the borrowers. They built the debt when money was nearly free. Now that money costs real interest, and the revenue to pay it still hasn't shown up. A household that bought a house with a teaser rate mortgage faces the same wall. The cheap period ends, the payment jumps, and the income never rose to match. But here's the part almost nobody covers. A geopolitical rival found a way to make all of this much worse. In January 2025, a Chinese company called DeepSeek released a model that performed nearly as well as America's best, at a fraction of the cost. Within days, about $1 trillion in US AI market value evaporated. NVIDIA set the record for the largest single-day loss by any company in history. How did they do it? Largely through distillation, training a smaller, cheaper model on the outputs of a larger one. In February 2025, Anthropic accused 3 Chinese labs of running over 16 million queries through roughly 24,000 fake accounts to distill its Claude model. In April, the White House accused China of industrial-scale campaigns to steal American AI models. In June, Anthropic told the Senate that Alibaba ran the largest such effort yet, 28.8 million interactions through 25,000 fake accounts. Think of it like a student who photocopies the honor student's notes, then sells a cheaper study guide. The notes were expensive to produce, the copy is cheap. Distillation itself is legal. Every major lab does it to its own models. The problem is when a rival nation does it to a competitor's model, then deploys the cheap result to undercut the revenue base of the industry it's targeting. The price gap is enormous. Chinese open source models cost about 5 times less to use than top US models, while scoring within a few points on standard benchmarks. Coinbase cut its AI bill nearly in half by shifting to Chinese open source models. Lindy, a US AI company, moved off Claude onto DeepSeek when its AI costs grew larger than its payroll. An estimated 80% of US AI startups now use Chinese open source models. This isn't a price war. It's a strategy to weaken the revenue stream American AI companies desperately need to service their debt. When a competitor offers a product that's 80% as good for 20% of the price, the market leader can't raise prices and may have to lower them. That's exactly what China wants. It doesn't need its own AI firms to be profitable short-term. State support can sustain losses indefinitely, as long as the strategic goal, undermining US profitability, is achieved. Compare it to how a discount retailer undercuts a local shop. The newcomer doesn't need to win on margin, just on volume and patience. China can fund its labs through state banks that answer to industrial policy, not quarterly earnings. The US firms answer to shareholders who want growth now. That asymmetry is the whole game. One side can lose money for a decade. The other can't survive 2 bad quarters. And the damage isn't only to stock prices. AI infrastructure needs power, staggering amounts of it. Data centers are now competing with households for electricity in parts of the country, and that competition shows up in your utility bill. The same debt that's propping up the AI bed is also bidding up the cost of keeping your lights on. You're paying for the boom twice. Once through your index fund, once through your meter. Think about who's actually carrying this. The people who built the data centers aren't sharing in the stock gains. They're paid by the hour, and their raises haven't outpaced the rent. The people whose pensions are being loaded with AI debt didn't vote for that exposure. The boom is concentrated at the top. The bill is spread across everyone. That's the defining feature of this moment. Not that AI exists, but that the upside accrues to a handful of owners while the downside risk is socialized to the public. And the risk is being spread to you. Banks making these loans know how shaky this is, so they're doing what they did in 2008, slicing up the risky debt, dressing it as safe, and selling it off. A law firm tracking this found lenders pooling AI data center loans and selling pieces to pension funds, insurers, and asset managers. The Federal Reserve reported major life insurers already have nearly $1 trillion tied up in private debt. Pension funds have started committing to debt funds fueling Meta and Oracle. That means the risk isn't contained in Silicon Valley. It's in your pension, your insurance, your safe, bond fund, and, as we opened, your index fund. If the AI bubble bursts, the losses land on teachers' pensions and union retirement plans, not just hedge funds. And here's the trap. By spreading the risk so wide, the banks create a political imperative. If AI stumbles, the government feels forced to bail it out, because the damage would otherwise be too broad. That's the too big to fail playbook, reprised for the AI era. We've seen this movie. In 2008, the banks bundled mortgage debt, sold it as safe, and when it cracked, the public paid. The executives kept their bonuses, the taxpayers ate the loss. The AI version uses data center loans instead of mortgages, but the structure is identical, private gain, public risk. The only difference is the scale, and this time the bet is bigger than the entire 2008 housing market was at its peak. Step 3, the subliminal step. Step back from the names and the numbers. Look at the structure. This isn't a few bad actors scheming. The incentive structure rewards exactly this behavior. When the goal is infinite growth on a finite planet, and when executives are paid in stock that peaks this quarter, the rational move is to borrow now, build now, and let the future sort out the bill. The shareholder-first model doesn't care whether the revenue arrives. It can't. Its job is the next earnings call, not the next decade. And once the debt is big enough and spread widely enough, failure becomes unthinkable, not because the business is sound, but because the damage from failure would be too broad. That's the leverage the borrowers hold over everyone else. They don't need to succeed. They need to be too big to fail. The AI companies already know this. In November 2024, OpenAI floated the idea that the federal government should backstop its financing, that taxpayers should help guarantee the debt behind its build-out. The backlash was immediate, and the company walked it back. But the CEO had previously said that, when something gets big enough, the government is the insurer of last resort. Notice the order of operations. Build the debt first. Make it systemic second. Ask for the bailout third. By the time the request arrives, the alternative, a crater in every pension and insurer that holds the paper, is worse than paying up. That's not corruption in the cartoon sense. It's the system working exactly as designed, with the public positioned to absorb the loss. Meanwhile, Anthropic CEO calls for binding regulation and the power to block any model deemed dangerous. On the surface, that's safety. But the same rules that make AI safer also raise barriers to entry, making it harder for open source competitors, especially small ones, to exist. And the hardest competitors to regulate are exactly the cheap open source models flowing out of China. So the push for regulation, sold as public protection, conveniently serves to protect incumbent US companies from foreign competition, while building the political case for future bailouts. When you see the same firms asking for both a bailout and a moat, understand what's happening. They want the public to carry the risk and the incumbents to keep the reward. That's not a contradiction to them. It's the strategy. So the crack in the basket isn't a bug. It's what happens when an entire system bets everything on one unproven payoff while loading the risk onto everyone else. The technology may deliver. The companies holding the debt may not survive to see it. Look at the government's dilemma, because it tells you everything about who gets protected. The AI companies are already positioning for a bailout. In November 2024, OpenAI floated the idea that the federal government should backstop its financing, that taxpayers should help guarantee the debt behind its build-out. The backlash was immediate, and the company walked it back. But the CEO had previously said that when something gets big enough, the government is the insurer of last resort. That's not a slip. That's a request, stated plainly. At the same time, Anthropic CEO calls for binding regulation, mandatory safety testing, and the power to block any model deemed dangerous. On the surface, that's about safety. But many analysts point out the same rules that make AI safer also raise barriers to entry, making it harder for open source competitors, especially small startups, to exist at all. And the hardest competitors to regulate are exactly the cheap open source models flowing out of China. So the push for regulation, sold as public protection, conveniently serves to protect incumbent US companies from foreign competition, while building the political case for future bailouts. This is a classic pattern. When an industry can't win on price, it tries to win on regulation. And when it can't survive on its own, it demands state support. The government is caught between its stated commitment to free markets and its strategic need to maintain AI supremacy. But the market has already shown it can't sustain itself without intervention, and the state, in turn, is reluctant to let the industry fail because AI now accounts for a huge slice of America's economic growth. Every major infrastructure revolution followed this. Our canals in Britain, railways in Britain and the US, the internet. They all went on to change the world, but the first wave of investors was wiped out. The technology delivered on its promise. The revenue came too slowly to save those who borrowed too much, too soon. AI is different in one respect. The price pressure isn't normal competition. It's a geopolitical rival deliberately undercutting the industry's ability to generate revenue. China doesn't need its AI firms to be profitable. It only needs American AI firms to be unprofitable long enough for the debt to become unsustainable. Step 4, the leverage. You can't avoid this bet. Your pension, your insurance, your index fund, they're already tied to AI. You don't need to invest in AI. AI already invested in you. But you can protect yourself by knowing what you actually own. Ask where your yield comes from. Look at the concentration in your index funds. If 10 companies are 40% of your diversified portfolio, you're not diversified. A target date fund marketed as safe still rides the same basket. Diversify beyond AI, not because AI won't succeed, but because the timing is uncertain and the debt overhang is real. Push for transparency where you have a voice. If you have a pension or 401k with a fiduciary board, ask what exposure it has to private AI debt. Those boards answer to members, and pressure from members changes what they buy. You have a right to know if your retirement is backed by circular chip financing. There are already examples of this working. Public pension members in several states have forced boards to disclose private debt exposure and, in some cases, to cap it. None of that made headlines. It didn't need to. A single board vote, prompted by a few members asking the right question, shifted where millions in retirement money goes. That's the whole game at the local level. Not a revolution, just a question asked loud enough that the people managing your money have to answer it. Support the boring, unglamorous rules that actually shift leverage. Utility board elections decide who gets priority on the grid, and right now, data centers are winning that fight in some states. Show up to those meetings, or at least track who your pension is backing in those votes. Antitrust enforcement against the giants isn't radical. It's how markets are supposed to work when one basket holds everyone's eggs. And talk about this. The reason the risk stays hidden is that the language stays technical. When you say my index fund is 40% 10 companies, people get it. When you say my pension is holding AI data center debt that's been sliced and sold, people get it. The system survives on everyone assuming someone else is watching. Nobody is. Look at the pattern across your own life. The same logic. Borrow big, concentrate, socialize the risk, shows up in your rent, your hospital bill, and your streaming subscription. Private equity buys the building, loads it with debt, and raises your rent. A private equity chain buys the hospital, and the quality drops while the bill climbs. Free companies own most of what you stream, and the price keeps rising while the content thins. Same model, different aisle. Diversification isn't just buying a different fund. It's recognizing that the same concentrated bet is wired into everything you own indirectly. If your pension holds the debt, your insurer holds the debt, and your index fund holds the equity, you're triple exposed to one story. The practical move is to map those exposures and push each one towards something broader. You won't win the argument by yourself, but a room of pension members asking the same question changes what the board buys. The historical lesson is brutal. Having the right thesis with the wrong timing is the same as being wrong. Every infrastructure revolution, canals, railways, the internet, changed the world, but the first wave of investors was wiped out. The technology delivered. The revenue came too slowly to save those who borrowed too much, too soon. And the workers building this, the data center technicians, the annotators labeling training data for poverty wages, the utility crews keeping the lights on, they're not the ones with stock options. They're the ones whose labor produces the value that flows to the top. When the boom is concentrated and the risk is socialized, the people doing the actual work are left holding nothing but the bill. That's not a flaw in execution. It's the design. You can bet on the right technology and still get hammered by the debt and the concentration. The people wiped out in 2008 weren't the ones who thought housing would never crash. They were the ones over-leveraged and over-concentrated when it did. Your retirement shouldn't rise and fall on whether 10 companies can outrun their own debt. But it does, until enough of us notice the basket has all our eggs in it, and ask who decided that was a good idea, and who gets to walk away when it breaks. The system isn't mysterious. It's a set of choices about who owns what, who bears the risk, and who collects the gain. Those choices got made in boardrooms and regulator offices, not in your name. The only counterweight is enough people deciding the arrangement is unacceptable, and acting on it where they actually have leverage, their pension votes, their utility board, their antitrust regulators, their own willingness to say the quiet part out loud. AI will change the world. That's almost certain. But the current constellation of companies, debts, and investors may not survive to see that world. The people who built the data centers, train the models, and pay the electric bills will still be here. The question is whether they own any of the upside, or whether they were just the ones holding the basket when it dropped. So read the next earnings headline with this in mind. Every record high in the index is a record high in your exposure to one bet. That doesn't mean sell everything. It means know the basket, name the risk, and stop pretending the boom at the top has anything to do with the life at the bottom. It doesn't. And the people who built the machine are counting on you not noticing.